I will do everything I can as Prime Minister to steady the ship over the coming weeks and months. But I do not think it would be right for me to try to be the captain that steers our country to its next destination. This is not a decision I've taken lightly, but I do believe it's in the national interest to have a period of stability and then the new leadership required. There is no need for a precise timetable today, but in my view, we should aim to have a new Prime Minister in place by the start of the Conservative Party conference in October.
Hello and welcome to Business This Week. Hello and welcome to Business This Week. I'm Nozi Pumbandra. David, did you see that coming?
Well, let's put it this way. Last night on the show, which unfortunately you weren't here, we had our usual panel of experts, and I made them all and everyone we interviewed say, so who's going to win and by how much?
Yeah.
And everyone said the vote is going to be to remain by between 55 and 62. I can't say I predicted the Brexit, but I did say it could go the other way by 1 or 2%.
Well, I think we've got a couple of scores to settle. One of those people I've been told during the week, his name is CliveRamathibela-Smith. He just so happens to be here tonight. I think he was on the side of the fence that also said that we would see a remain. So I'm going to be pulling out all the cards and really going at him for that. But of course, the big question is, how did no one see this coming?
Well, I'll tell you why no one saw this coming, because there's no precedent for it and there was no evidence, no research, no previous experience, not like general elections, to guide us. And everyone wants to say there's research on these polls. Actually, nothing like this had ever happened before. So actually, it was guesswork.
And of course, we saw the market reaction. We're going to be talking about that. We saw the reaction on the Rand in South Africa. US markets sent into a tailspin. We saw the global markets spill over as well. All of this and more when we get into our panel discussion, which is coming up next.
That's right. But let me tell you something. By Monday, it's all going to calm down. This is not a global financial crisis where the world is in a crisis. Everyone will come to their senses. The sun will come up, even in Britain where it rains all the time. And I think everything's going to come back to normal pretty quickly. On the show tonight, do we talk about that yet?
Yes, I think we can intro our guests, or otherwise we'll sit here all evening talking about the weather in Britain. Colin Coleman, Managing Director of Goldman Sachs, is going to be part of the panel that we're going to be having now. Of course, CliveRamathibela-Smith of Clivera-Inc Incorporated, he's going to be here. I'm told he's wearing a tie today to pay for his sins because he got the call wrong. And we've got a newbie on the show.
We've got Ronak Gopaldas, who's Head of Country Risk at RMB, and Mike Schüssler, Chief Economist at economists.co.za.
But of course, we're not just talking Brexit. As David said, the world does go on. One of the things we're going to be looking at is the social media sentiment of the week, and we're going to be doing that later in the show. And to wrap up Youth Month, we're talking to Bulelwa Mtsali. She is the only black female to have built a media company that was bought by Naspers. And she's going to be joining us later in the show.
I would have said it was you if you didn't tell me
that.
I
know, it's hard to believe, but let's get into people, prices, and profits.
Right, let's get into our discussion. What we are going to be doing, as you'll see there, we have two screens. So the one is the live feed from our colleagues at CNBC in Europe and the US. So we're keeping in touch minute by minute live for developments there. And of course, you've got us live here as well. And we'll switch between the two as we go.
Absolutely. Well, let's get into our first discussion. Guys, thank you so much for being here. Colin, let me start off with you. We know where Clive was at in terms of his reading. Did you see a Brexit? Did you think we would wake up to a Brexit?
It's not so important what we thought. We need to talk about what's going on. And I think today what we've witnessed is a shock in the markets, no question. But liquidity and the markets are functioning, fortunately. I think David's made the point that this is not a global financial crisis. There are functioning markets, there is liquidity, and markets are finding their levels. So what we've seen is some quite dramatic volatility, but it feels like the market is settling, as we look into the late afternoon of South African trade.
A quick one before we move on. If we can look at the immediate impact in terms of just the reaction of the equity markets, the bond markets, and so on. But what's the long-term effect that we're likely to see on the global economy?
Well, that's the million-dollar question. You know, the million-dollar question people will be asking, is this a market repricing, or is this a rebalancing of the world economy, which may see us tip from an anemic recovery into more of a global recession? And that is what people are going to, I think, be analyzing over the next period. There's no question that global growth will have been negatively impacted by this event, and by speculation as to what the future of the European Union as one of the major economic blocs in the world will be, and what this will do to China, to the United States, and the other major economic blocs. Of course, South Africa, a relatively open but small economy in the world, is going to be a price taker in the situation. And unfortunately, given our domestic situation, which we're working very hard on, this will not be positive for the South African environment. So we didn't really need this domestically as another global factor pushing in this direction. But I think the central bank and the finance minister today have made clear that South Africa is, you know, from a systemic point of view, well placed to weather the storm.
Clive, let's bring you in here. And just before we came into the studio, you said we need the weekend to digest this. So the weekend comes at a good time. Yeah. Do you agree with me that things will settle? We've already heard the word settle. Markets are settling. Yeah. Monday, where are we going to be this time Monday?
I reckon Monday what will happen is that over the weekend that people will start rethinking about what this actually means, because I don't think a lot of people still understand the significance of what has happened today. So all this now will be digested appropriately, and people will come back with fresh minds on Monday, fresh perspective, and they will want to make sure that they understand the environment that has been created, and so therefore they'll adjust. You remember that, you know, most of our markets are controlled basically by algorithms. So what happens is that because these things were set, and I was watching this throughout, from 12 a.m., I was watching and seeing this actually unfold, and we thought even at 5+3 in the morning, early hours this morning, I was still thinking that the Brits will remain, and therefore 3:30, which is 25 minutes later, the scale had changed completely. And so that's when the market had to respond, because nobody actually anticipated what happened.
We'll talk about the winners and losers on the market in a moment. But Ronak, you look at risk on the African continent. What does this mean now for how investors are going to be looking at African markets? And is there an impact at all?
Yeah, everything's changed. You know, I read an article this morning saying that this is like a reality TV show that's just become reality. And that's exactly the point. You know,
so an unscripted Kardashians.
Oh dear.
Africa is subject to contagion. You know, we've had a global shock to the system. People, when this happens, become uncertain. They become anxious. Things are unpredictable. So there's a flight to safety. So we've seen the gold price rally to a 2-year high. We've seen oil drop significantly today. We've seen emerging market currencies come under pressure. And I think we've still got more questions than answers. The hard work starts now. On what terms is the UK going to exit? Is it going to be a big bang? Is it going to be a negotiated kind of landing, or something that's completely unknown? And I think, given all of these factors, I still think we're going to see extreme volatility come next week.
Yeah, there's this 2-year timetable. What interests me about David Cameron, I mean, it's like Sepp Blatter at FIFA. I'm resigning, but not yet. Yeah. Not in the British tradition for prime ministers to resign and then hang about, because he's now a lame duck. He's a dead duck, in fact. No one's going to listen to him. No one's going to take him seriously. So apart from that, which I think is actually going to create instability in Britain, there is this 2-year timetable, Mike. So, I mean, part of the calming down and the settling is it's saying, look, we're not disappearing overnight. Trade deals are not going to be just cancelled. We've got 2 years to realign, sort out, and find a new way.
Yes, let's put it this way. You know, Sandton is now becoming a place of lawyers. The City of London was a place of merchant banks. I think it will also be replaced by a set of lawyers, because ultimately the people that are going to make money are the people that are going to be looking at the trade deals, the new trade deals. All those things are up there. I think for us, however, to take it back to South Africa, for me, the back door for South Africa in the last while has been the commodity market. And that's really knocked our economy apart from our own mistakes, I think Colin will agree that the commodity prices have taken us and Africa to a large extent away from any hopeful growth. And I mean growth here of more than the population growth. So Africa is going to go through a period of a year or two of less than population growth, there's no doubt. But this thing, it may just knock us even further, and that's where we are right now. And that's what the real concern is. You know, I'm an economist, I'm not a politician. I don't know. I know that 84 members of the Conservative Party said they still support David Cameron and they want him to stay. Obviously, he's not staying. So his support base is going to wane very quickly. But who's going to take over this thing? Because now somebody has to negotiate somewhere out, and that negotiating somewhere out is going to hurt a lot of people. And it's going to hurt a large part of the world economy. And that is the concern I have. And for us, that hurting of the world economy is going to be very, very detrimental to commodity prices and therefore to South Africa. That's the way I see it at this moment.
Colin, what about a domino effect? This was the big question of, is this the end of the Eurozone as we know it, and who's likely to be next if that's a possibility?
Okay, let me just, if I can comment on the South Africa end just a second, just to capture something. There are certain features that are anomalies that actually may play to our advantage. So the credit, for example, and the liquidity of the South African economy, and the fact that we are in the global growth markets, one of the few liquid growth markets in the Eurozone time zone that are not in Europe. It means that actually South Africa as a growth market could benefit. In other words, people may trade us instead of trading, or Turkey, instead of trading Hungary or Poland. So that's an interesting, but that's a sort of market arbitrage, if you like, that may play out going forward. We were knocked quite heavily. I mean, 5% on the rand is a very significant knock. Obviously, in the lead up to the Brexit vote, there was a very strong rally on the expectation of a stay, and so there's a little bit of that built in. On Europe more generally, we don't know. I mean, one cannot really anticipate, well, what are the knock-on effects in Europe? But what one fears is that there is a potential for a growing nationalism, for that nationalist movement to play itself out in various countries. And there will be a question as to what the future of the European Union itself will be. It was interesting to see Claude Juncker, the president of the European Union, make his statements today. He was very clear that they want a quick negotiation to bring the certainty back into the markets about the future of the Eurozone. So I think South Africa has got a very interesting place in all this. Again, you know, if we don't shoot ourselves in the foot, there are certain upsides that we can.
Well, we've usually got two revolvers pointed at both feet in South Africa. But David Cameron could go down as the Prime Minister who wrecked the European Union and who wrecked the United Kingdom, because now they're talking of splitting up there. That's quite a legacy for him. But Clive, let's look at companies that have benefited from this. I mean, gold companies to start with. The gold price, when I looked this afternoon, 4.5% up to $1,312 an ounce. So you start looking at people invested in gold and in gold companies. So the upside for investors in companies.
Well, we know that first and foremost we have to acknowledge the fact that the JSE is got a lot of number of companies that are actually linked with the London Stock Exchange. So obviously, automatically there will be some sort of volatility that happens, the movement that will happen between the two companies or the two countries themselves. But what we've seen is that when people panic, they go to what they trust. So therefore, that's why the gold stocks would have done relatively well today. And my biggest concern, Dave, which maybe a lot of people don't look at, London has become the hub where financial institutions out of Europe rely on. Everybody around the Eurozone trusted London as that. Will London continue to be the hub and the safe haven for institutions like that? And if then they've exited, why would EU companies want to actually still go back to London? And that is my biggest concern about this exit. And so therefore, yes, people will go back to the safe havens, and maybe perhaps on Monday, there's still volatility, but at least we are much more straight and direct about our thinking. But that doesn't change the fact that London has become the capital for those particular
Mike, are you going to challenge him or endorse?
No. I'm going to add, but from a different angle. I'm going to say 40 years ago, when the romance started and this marriage started between England and the EU, we were told at that stage about the Gomes of Zurich. And that meant that Switzerland was very much more a financial hub than it is today for Europe. And today, London is that financial hub. And that's where the change will come. And so where Colin works, his head office is New York, but his secondary head office is London. So now it changes and it goes to a Frankfurt or a Paris or a Zurich. And that changes the whole thing.
Yeah.
So the next time we speak to Colin, we might call him Putkin. And it's this type of thing that's going to change, because London made a lot of money. If you think of the city of London, and that's 1 square mile, but you look at the whole of London, there's a lot of people in the financial markets there. And that amount of people there might be less. And that's always had a very close relationship to us here at the JSE, which I think is still in the top 15 traded equity markets in the world. And that might change now. So there's another secondary effect for us. We don't know all the outcomes. We certainly don't. And it's not about shooting ourselves in the foot here with both guns. It's just something that's happened to us that is going to impact us in a very big way, whether it be commodities or the liquidity. Because, yes, we have a lot of liquidity for an emerging market, but it might also be that other emerging markets now become favorites.
I want to sneak in a final
I also
question.
wanted to sneak in a final question.
So we're seeing, I mean, taking from Mike's analysis, Ronak, there's also the question of what happens to economic ties and trade links. Do we now have to reconsider the relationships that we have with some of the European countries, or does that not change in any significant way? Because I'm sure we have bilateral relations with Britain anyway.
So this is the key question on everyone's lips, and the reality is, if you look at something like the recent EPA that was signed with the SADC region, it still stands from a European perspective, but the UK need to renegotiate their arrangements with countries, and that's going to be a long and arduous process, because on the one hand they've still got the 2 years to negotiate the terms of their exit, and then they need to renegotiate with the 161 WTO member countries, which is going to be a long, bureaucratic, legally cumbersome process. So I think that's really going to breed more anxiety, more uncertainty. If you're a company sitting globally, it leads to investment paralysis, because you just really don't know what you're dealing with and how you come out of this equation.
I'll tell you, before we go to break, I want these guys to think about this. Why is it that London can't stay the financial capital of the world because of this arrangement? Don't answer now, but think about it. And I want the layman's explanation here. Why is it that all these good guys in London can't carry on doing what they're doing because this relationship has changed?
So
it's Brexit this week.
Oh, Brexit this week. That's a clever one. Still with us, our guest, Colin Coleman, Managing Director at Goldman Sachs International.
And Ronak Gopaldas, who is Head of Country Risk at RMB.
CliveRamathibela-Smith, Investment Specialist at Clivera-Inc. And I don't know why he does that sign, because that team always loses, but anyway.
Don't follow him, follow the birds. And Mike Schüssler, Chief Economist at economist.co.za.
So let's pick up on a point I know that you want to talk about, Colin. I mean, Investec down 8% today. There are lots of South African companies that have been impacted, Colin. But what is the overall reading as you look at the impact on corporate SA?
You know, the current trend going back now a year or so, which you've seen, is diversification of South African corporates. South African corporates buying cash flow using South African earnings effectively offshore and building businesses. We've seen many examples. Obviously, the nature of risk diversification post-Brexit is going to change. And people are going to ask, so what is the risk diversification buying the South African corporates earnings? European earnings or UK earnings, and is that a good bet? At what price? And so it throws a new dimension into the mix around the risk diversification play, which is one of the major trends in corporate South Africa today.
A quick follow-up to that. I mean, we've seen a trend of South African companies who are investing in the UK, doing so with the purpose of being broadly exposed to the European Union and the consumers there. I mean, I know Steinhoff came off short today with their offer for Poundland, but in essence, that link has now been disconnected. So what happens to those investments? Are they now at risk because of the disconnect between the UK and the broader European Union?
So I think the risk reward has probably been brought into question now. So people will start to reprice that risk reward relationship. So the question will be, will people double down now and take advantage of companies that are now worth much less and buy into what is been perceived until now as a low growth but safe market.
Right.
Now maybe the risk factors increased, the equity risk premium will have increased, and therefore the returns have to be commensurate with the growth. So I think corporate South Africa is likely to revisit the question of where do they want to invest offshore. Will it be Australia? Will it be Asia, the Americas, relative to Europe and the UK?
But I think the important thing is it's still going to probably be focused offshore, not necessarily in South Africa, because the risk reward in South Africa is seen by many top business leaders in South Africa as very, very unhealthy.
Yeah, and
I still want to answer to my question I posed earlier, but you want to talk about the rand
Yes,
first?
I want to quickly talk about the rand, which we know, of course, plunged today. I think the number was around 5% as Britons voted in favor of leaving the European Union. CNBC Africa spoke to Stephen Harnevel, who's the chief economist for the Department of Trade and Industry, to find out how much more of a ripple effect the Brexit could have on the country.
I think it's quite a difficult time at the moment. We won't really know for at least another couple of months what the real impact will be. But there are a couple of areas that we would be a little bit concerned about. The first one is the possibility that what's happened in the United Kingdom will tip either the United Kingdom economy or the global economy into a very volatile period again. So we're a little bit worried about that, but we are monitoring it. We hope that the overall impact won't be too significant. I think what is perhaps a bigger risk for South Africa is the likelihood that the rand will become very volatile again. And we've seen that this morning already. Although the pound has dropped quite significantly, the South African rand has also dropped quite significantly. However, our trade relationship with the United Kingdom is very stable, and it's been stable over the last 20 years or so. So although there are some risks to it, our overall sense is that it likely won't have a major impact in terms of trade relations. Of course, the depreciation of the rand will make South African goods much more competitive in the United Kingdom.
Well, certainly volatility in the currency there and expected to be more. Mike, perhaps you can pick up my question. Everyone talking about property prices. We talked about companies winning, companies said to be losing, and this was predicted in the event of an exit. Capital and counties exposed to the upmarket office and the great growth in London property and so on. So why can't London keep, I mean, it's not like people are going to be banned from going there or they're going to be taxed more.
Absolutely, but let's look at Asia, which doesn't have that sort of financial capital thing. You have Hong Kong, you have Tokyo, you have Singapore and Shanghai. So I think Europe is going to go more in that direction, and I think that a Paris or a Zurich or a Frankfurt, Amsterdam will probably pick up more market share now, and there'll be a lot of banks looking at this and saying, wait a minute, the cost of trading in Europe because of a single currency, which is maybe not the greatest currency, and it's not something that I'm pro.
But the British don't have the euro. So
no, they don't, but there's also then the other parts that come in, which is going to make those transactions sort of, let's call it an international transaction right from the start now, because it's no longer going to be part of the euro. So there's other questions and other admin and other things involved. So it's going to look very different in the future. And although I'm not a legal expert, but the one thing that I've been doing today in the reading that I've seen is I think this is a territory for lawyers. And if I want to avoid a lot of legal costs and a lot of legal hassles, new things that I issue might be more in the EU area than in the London area. I'm not sure how these things are going to work, but I think there's something to be said for that. And I think we're heading for a more Asian sort of spread of the financial markets, because, look, the legal market will remain Brussels. The trade market, Rotterdam or Amsterdam or Hamburg or whatever, Antwerpen, and certainly the central bank will remain in Frankfurt. So, you know, there's a different sort of dynamic that's going to start playing out. And I don't think the financial market will remain as dominant as it was now. It may still be dominant, but not quite as much.
Just a quick one, because you've touched on central banks, and maybe Clive, let me throw this to you, because I want to get to Nigeria and Kenya with Ronak. Should we be expecting a different stance from central banks? I'm thinking about the Fed and the kind of commentary we had leading up to Brexit, and how even Yellen speaking wasn't expecting that we would be waking up to today's news. What do we expect from here on?
No, well, nothing will change in the United States because they've got a very strong financial system. So they understand what the market's with. And I promise you now, they would have made a plan already of either or. So they would have made a plan for what would be the outcome of what happens in the UK. But here's something interesting that Marcus mentioned about the financial hub being spread a little bit. And my concern here is that, you know, if you're EU, you must put regulations to control the countries that you have left. You've got 27 countries now, and you have to make sure that you're competitive. How do you make sure that you show that exiting, I'm going to use a term that is very well known in this country, that it is cold outside the EU. You know, so how do you make sure that the guys understand that without also putting a detriment on the fact that you're still having partnerships with the rest of the world? So that's going to be their biggest challenge. If they slot the rot and they hit where it hurts the most for the UK, then the rest of the guys will say, and I can tell you now, the Netherlands are the country that would be thinking about a referendum. I know that Denmark will be thinking about a referendum as well. France is in trouble because their own economy is under pressure. And people like Greece, for example, will think, maybe if we knew that the UK can exit, maybe we should have left in the first place.
Let's add two more countries to that, Ronak. Let's add Nigeria and Kenya as some of the big economic hubs on the African continent. We've spoken about South Africa, but should we be looking more continent-wide in terms of the impact?
Yeah, so let's start with Nigeria. We know that the country devalued its currency this week in a bid to attract portfolio investment. Now you've got global risk aversion. You know, they're not going to be as successful as they anticipated. Look at it from Kenya's perspective. Biggest markets for their flowers, UK and the Dutch. Now, if the Netherlands is thinking about a referendum and exiting it as well, that's a big impact on their trade balance. I think the other thing to consider is, what does this mean from an economic diplomacy perspective? Do we see the UK becoming closer to the Commonwealth countries now that it's no longer in the European Union? Are we going to see them maintaining the level of donor support for many African countries? So I think that's also a really important point to consider in the process of how this whole thing unravels.
Yeah. I still don't follow why Kenya can't keep selling flowers and get the same money back from the British pound.
Well, it's two forms now, you know, it takes a bit more filling in.
I just think these things can be sorted out. Colin, unfortunately, we're running out of time.
Sure.
It happens to fall to you to wrap up things here. And, give us a bit of a perspective now going beyond this weekend and where you see things going.
Look, globally we'll have to watch. I think the real message to South Africans is we're going to have to batten down the hatches. We're going to have to learn to save. We're going to have to learn to invest wisely. We're going to have to learn to be much more productive with our capital, because the world's going to be in a tougher place. And we're already way off our growth rates. We should be at 3 to 5% growth rates at least. We're at 1%, under 1%. This could push us lower, which is unfortunate. It's not of our making. So we have to work harder with what we have. That's the key message I have.
Well, we've got to work harder with what we have. That's how we wrap up this part of the show. A very big thank you to Colin Coleman, Managing Director at Goldman Sachs International. A big thank you to Ronak Gopaldas, who's a country risk analyst at RMB, as well as Clive-Ramathibela-Smith from Clivera-Inc, and of course Mike Schüssler, Chief Economist at economist.co.za.